is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Shifting gears, European markets continue the global rally boosted by Fed Chair Jay Powell, signaling a possible slowdown in rate hikes this month. Weaker variant Beijing allows some patients to isolate at home after a top official says the country is entering a new stage in a fight against the pandemic, indicating a softer stance on lockdowns. And close to nothing, FTX's founder claims the crypto empire's fall wiped out nearly all of his entire fortune while apologizing for the company's collapse. Now, first thing is first, so let's check on the markets. We're seeing a nice little lift for European stocks across the board. Now, this is really on two main stories, China and the potential taking out of lockdowns, or certainly a softening on the stance when it comes to zero COVID policy. The other story is, of course, Jay Powell. Now, we did have some important analysis by our Mark Cudmore, our managing editor for MLive, saying, look, Jay Powell pretty much delivered what the market was expecting, so look out for data. That's the important data coming out of the U.S. U.S. 10-year yield 3.6347. S&P futures pretty much flat. And then we also look at sterling 1.2114. We had some inflation, we had some housing prices, actually, nationwide survey, and housing prices in the UK for the month of November fell much more than expected. Of course, that's a correlation with higher borrowing costs, higher mortgages. This is a picture overall for the FTSE gaining some 0.2%. I think it's mainly, all of the industry groups are gaining apart from energy, which is down some 0.4%. The other big story, and we are very data dependent. Certainly central banks are looking at data, so we follow what central banks want to look at. Euro area November manufacturing PMI coming in pretty much as expected, 47.1. This is the final reading. The preliminary had it at 47.3. As expected, it is a contraction, but as expected, it doesn't have a huge impact on euro dollar because this was pretty much priced in. So again, euro dollar 1.0436. Now, the Fed Chair, Jay Powell, cemented expectations of a deceleration in tightening starting with the December hike. He also presented a case for achieving lower inflation without tipping the economy into a deep recession.
As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections.
Investors welcomed the shift in tone, with stocks and bonds rallying pretty strong. Now, we're now joined by Geraldine Sundstrom, Asset Allocation Portfolio Manager at PIMCO. Geraldine, as always, thank you so much for coming on. What did you take from the Powell speech? It feels like it was pretty much as expected, and maybe markets are still too positive about the outlook for inflation coming down.
Yes, we would say that the delivery of Powell was very much as expected. He has acknowledged the fact that inflation is showing promising signs of coming down. But at the same time, he didn't give up on the fact that rates would have to remain relatively restrictive for a while. So we feel that the market has moved very fast on this news, and probably what now is going to be more complex and much more data-driven.
So, Geraldine, what does it mean, first of all, where you want to be invested on the yield curve, and how will that shift going into 2023?
The big question is how sticky inflation will be. It is quite easy to bring inflation from, say, 10% down to 4%, but from 4% to 2%, which is the target from most central banks around the world, is a completely different task, and where we think there'll be a lot more inertia. So the fact that the market has started to price quite a bit of cuts when it comes to the US curve in 2023 might be a bit premature. All the more than we're looking now at China reopening, which could boost commodity prices, which have helped quite a bit recently. In terms of yield curve, the fact that a lot of cuts are priced in makes us a little bit more cautious at this juncture, especially because we have an inversion of the yield curve that is pretty deep.
So, Geraldine, what does that mean? So going forward, I don't know whether you think there's still a small chance, and whether that chance is 10 or 15% that we avoid a recession in the US, and what that would mean in terms of recalibration, for example, for fixed income.
Well, we think that the soft landing in some way has been, I would say, as of now, is pretty much priced fully into equities. Fixed income is looking a little better. We think that over time, if you can look through all the volatilities, the stickiness of inflation, and you have a bit of a longer horizon, you should be fine in high quality fixed income. But what's really important for us is that we can't put the cart ahead of the horse here. We cannot start to price the recovery in most asset prices when we haven't seen the recession yet. That's why the focus for us in terms of sequencing and re-engaging in risks in portfolio has to be first and foremost in fixed income. But at this juncture, it's not yet, pound the table. There's still a lot of uncertainty in terms of monetary policy and in terms of stickiness of inflation.
Geraldine, do you see anything of value right now in Europe? I know, again, it's amazing how the inflation shift changed in the UK because of in Europe in general because of the war in Ukraine and the extra pressure that's putting on ECB. But do you see a value play, for example, of bonds versus BTPs or something like that?
Well, most spreads now, especially bonds versus BTP, are probably fair. Not much very attractive currently in Europe. The Euro stock has been very strong in relative terms. The dollar is a little expensive, that's for sure, but it could remain still expensive because the trade balance, Europe is going to be very sensitive to a global recession in terms of export and has to import relatively expensive fossil fuels. So not yet attracted by the euro. We think that equities are too sanguine when it comes to earnings forecast. And the war in Ukraine remains a substantial unknown, especially when we look 1 year from now and what's going to happen in the winter. So in terms of region, we prefer to focus on the US, which feels like a more secure place.
Geraldine, I love in your notes how you put, look, if you look at cross-asset valuations, you go from TINA, there's no alternative, to TARA, there are reasonable alternatives. Do you see any of those alternatives in the UK or emerging markets?
Yes, I think emerging market is a little bit ahead of developed market in this cycle, which is quite unusual. Central bank have started to hike interest rate much earlier than developed market. And so we see that, the hiking cycle is coming to an end in a number of places. The level of inflation has started to come down, and therefore the real yield differential with developed market is looking very attractive to a level that's rarely seen. At the same time, a number of these currencies, because of terms of trades and current account balance, are looking relatively undervalued. So one area where we're willing to sort of dip a toe and step is into select emerging market currencies, notably in Latin America, which offer high carry and yet on the right side of things when it comes to commodity and trade balance.
Okay, Geraldine, very quickly, what's the one thing that you think, I don't know whether we're talking about bubble, I don't know whether it's a certain type of an asset class, but is there a warning sign or an alarm bell going for something that you want to get out of in the market now before 2023?
No, I wouldn't say so. If I knew that, that'd be great. There will be surprises. Interest rates level have risen globally extremely fast. And now and then, we're going to find out about areas that are going to be more sensitive. For sure, the one thing, and that's playing already into fixed income market, is that some economies are way more sensitive to the level of interest rate. And here I think about Australia and Canada. And therefore, this makes the fixed income market probably, a bit ahead and more attractive than the ones in Europe.
Geraldine, as always, thank you so much for joining us. Geraldine Sundstrom, their Asset Allocation Portfolio Manager at PIMCO. Now, coming up, we'll take a look at China's changing tone on COVID curbs. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Beijing will allow some virus-infected people to isolate at home. A significant shift that reflects the pressure that officials are under from a record outbreak and growing signs of public opposition to COVID-0. Now, for more on the shift, let's bring in Bloomberg's Rebecca Chung-Wilkins, our Asia government reporter in Hong Kong. Good morning, Rebecca. So how is the tone actually shifting in China?
Well, this is certainly the biggest change that we've seen from authorities so far. We've seen them sort of downplaying the virus and China's top COVID czar saying that we're moving into a different phase, a new phase of COVID control as well. Two sort of big significant things. One is this focus on getting the vaccine delivered to China's elderly population. This is seen to be crucial if there's going to be full reopening. And the second is that Beijing will also start allowing low-risk COVID-infected patients to actually isolate at home. Now, that's something that Hong Kong also moved to do in the early stages of it when it was opening up.
So, Rebecca, how are things looking since the weekend's protests? Has the civil unrest actually calmed down?
Well, it's been relatively muted. I mean, we really saw sort of the apex of that disruption coming through the weekend, and in part that's because of the very heavy police presence that's been rolled out through many major cities in China, Beijing, Shanghai, and so on. We are also, though, keeping an eye on the fallout from the leader Jiang Zemin's death. Mourning in China historically is a period for people to legitimately come out on the street and gather publicly. So this may provide sort of some kind of opportunity to sort of rally protesters together. And we are seeing on social media as well some nostalgia for the period that Jiang oversaw, a period of great openness on prosperity, which is somewhat of a contrast to, of course, what people are facing now under 3 years of very strict COVID control measures under Xi Jinping.
Thank you so much. Bloomberg's Rebecca Chung-Wilkins there on the very latest out of China. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. In South Africa, a parliament-approved panel has found there are grounds to investigate President Cyril Ramaphosa in connection with a scandal over a robbery at his game farm. Ramaphosa's job could ultimately be at risk over the alleged cover-up. With lawmakers scheduled to debate the report's findings next week, the president has reiterated his denial of any wrongdoing. Now, President Zelensky says 6 million people are currently without electricity in Ukraine after Russia's attacks on the country's energy infrastructure. The Ukrainian president says he needs high-voltage equipment that can be repaired quickly, transformers as well as generators to get through the winter. NATO's Secretary General says the alliance must avoid repeating mistakes it made in relations with Russia and ensure it limits dependence on China. Jens Stoltenberg stressed that nations cannot make decisions solely on commercial considerations. He spoke to Bloomberg after foreign ministers met to discuss issues including Russia's invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Coming up, don't miss our exclusive interview with the Veolia Chief Executive, Estelle Brzeski. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the world's leading water company, Veolia, says it's completed the disposal of assets proposed to remedy competition concerns in the EU regarding its takeover of utility giant Suez. Well, joining us now is the Veolia Chief Executive Officer, Estelle Brzeski. Thank you so much for joining us today. When you look at some of the things that Veolia has said, you're very optimistic about the future in terms of earnings growth and the potential for Veolia. What does that mean you're seeing in the economy? The economy in 2023 could be a very tough operating environment.
You're right, Veolia is a very solid company, very resilient as well as very agile to adapt to the new environment we're facing today, be it in energy crisis or inflation altogether. We've delivered very strong Q3 results, and we intend to go on for the rest of the year as well as for next year. And what supports our growing of results is actually both our resilience, as I said. 85% of our business is really immune to the macroeconomics, as well as actually the benefits that we are delivering on the merger with Suez. We are ahead of our plan in terms of synergy deliveries. And altogether, the market we are a leader of is actually fast growing and super attractive, because we're talking about wastewater and energy and environmental services.
So talk to me a little bit about water. I know you're present, Veolia is present in France, Central Europe, Spain, US, and Chile. Are there groups, and I'm thinking of either certain types of companies or farmers that could, weather higher water prices? And is that what will happen in 2023? What we've rediscovered in some European countries or in the US is actually the preciousness of water this summer. And actually we're in the beginning of December and we still have water restriction in some countries, which is very, very rare usually in the start of the winter. The good news is we have the solution to tackle this water scarcity from improving the yield of the various distribution network of water, thanks to artificial intelligence in order to detect leakage before they appear, as well as, for instance, a specific technology of reuse wastewater to recycle it after it's been treated and to provide it to the industrial or agricultural consumption. It could be even human consumption. So we have the solution, and actually a company like Veolia is here to deliver them and to speed up in the various countries we operate. How are you expecting the energy compound to play out in 2023? There's a number of caps, for example, on prices in some European countries. We're also talking about a windfall tax. How would that impact Veolia earnings going forward? So in terms of earnings and directly, we're really well protected against all that since, the energy price is really passed through for Veolia's P&L, so the margin is protected, if you want, as we've seen this year, and we intend it to be the same next year. But I guess the energy crisis we're facing in various countries is another testimony that we have to speed up the getting rid of importing fossil fuel for strategic reasons, and I would say strategic autonomy of various countries, and of course the environment as well as price. And it happens that we have an untapped potential in Europe and in the US of energy source, which is the waste and the wastewater. Biogas, typically, which we can speed up the delivery of. It's a locally produced, renewable type of energy, which we can, again, produce more and more. And this can be very significant potential. And I guess that's why the energy crisis, again, we are totally fully protected in Veolia, but there is a potential for growing the business in sectors like the one I've just mentioned. But if you look at the windfall tax, that could be on electricity and biogas sales. Are you expecting more windfall taxes from more countries? And again, what does it mean for certain, places where you operate in? No, actually, we don't expect any impact of the windfall tax for Veolia. One big reason is because we don't have any extra profit from this crisis. I guess it's neutral for us. So we're not in the situation of generating extra profit from the price of energy. We are in the situation of benefiting from the fact that there is a trend to save more energy and to produce more green energy over the mid and long term, as I explained with the biogas example. But no impact expected of a potential windfall tax for Veolia. And that's why, the strong results we've produced for Q3, we expect it to be the same for the end of the year and for next year as well. I know Veolia also manages some district heating networks, for example, in Central Europe. If some of these assets were to come back on sale in France or elsewhere, would you be interested in bidding for them?
Actually, we are always interested in selling and buying assets to try to see where we can increase the most value for us. So we are always having a very agile version of our balance sheet, if you want, but nothing specific that we have in mind for the short term. And of course, I intend to maintain the big rigor we've had over the last few years in terms of buying. It has to create value, and we are very rigorous in terms of maintaining a leverage around 3 times EBITDA for our balance sheet. Yeah. So, within those constraints, we're always considering options, but I intend to still be very rigorous again.
In just 20, 30 seconds left, how do rising interest rates actually impact possible M&A and how you run the business? Actually, we are 85%, with fixed interest rates on our balance sheet. So I guess it's not a question for Veolia, really. Again, the question is more to select the opportunities we have, given the fact that we are in a market with a lot of potential on biogas, on energy efficiency, as I mentioned, on tackling the various scarcity of natural resources. Yep. And again, going on with delivering very good results. Thank you so much for your time today, Estelle Brachlianoff, there, the Veolia Chief Executive Officer. Now, coming up, we focus on the UK for our new show. This is Bloomberg. Hi everyone and welcome to Bloomberg UK, a new show with a special focus on the biggest challenges facing the British government, the economy, financial services and the markets. I'm Francine Lacqua here in London and this is a weekly show. So on the program this week, one of the best or most pressing issues in personal finance. We look at the sustained pressure that inflation is placing on the UK and housing, UK housing and mortgage sector, plus trying to get a big bang out of Brexit. Our finance team tells us how the city is reacting to reports that the UK will relax banking regulation. But first, we start our investigation into how the UK has become home to one of the world's biggest gambling industries. That's today's Bloomberg Big Take. And for more, we're joined by Gavin Finch from the investigations team, who spent months trying to figure out, of course, this industry, what it brought. And Gavin, first of all, congratulations to you and your team. It's a brilliant read. We also pushed it out on social media. It's a well-researched, thoughtful piece. Why is the UK so liberal on gambling?
So I think it can all be traced back to the Gambling Act of 2005. This allowed firms to advertise sports betting, casinos, and poker on TV and radio kind of for the first time. And somewhat unbelievably, until 2014, gambling companies based offshore could even sell to British customers without a UK license. But crucially, the law predated the arrival of the smartphone, and betting firms have been exploiting that blind spot ever since, developing aggressive habit-forming games tailor-made for obsessive gambling and cashing in while a significant section of their customers racked up huge losses. And while there have been several attempts to tighten regulation of the sector, the gambling industry has been very, very effective at lobbying successive UK governments that it should be left alone.
But Gavin, what are we looking at? Is this addiction, and does it show the direction of travel that other countries could take when it comes to people, losing a lot of money by gambling online?
Yeah, I think it does. What has happened in the UK in the last decade, the surging rates of gambling addiction, hundreds of suicides every year. Estimates put it at more than one suicide a day due to gambling-related harm. It's an object lesson in the dangers confronting the US as it emerges as the new frontier for gambling. Most US states have now liberalized their gambling laws in the last couple of years to allow online gaming. And all the big gambling companies are now queuing up around the block to try and repeat the same successes as they see it, as they've had in Europe, in the US.
So, Gavin, why have, first of all, online casino games become so popular in the UK?
So it all comes back to the smartphone. The iPhone really did change everything. Suddenly people had a portable device with this large screen, internet connection, a lot of processing power, and that was just perfect for these online casino games. Gambling companies have spent a lot of time and a lot of money designing these games to be highly attractive. And the smartphone was the sort of perfect delivery device for them. You know, you no longer need to walk into some forbidding-looking gambling store off the high street to place a bet. You can do it anytime you like. You know, you can do it on your commute, on the sofa, in bed. Everyone now has a virtual casino in their pocket.
And so this is why it's probably a lot more dangerous than other gambling products, right? These online casino games. What are we doing about regulation? There is also software, you put your, I guess, email address and saying, I don't want to gamble anymore. And it stops, you know, most gambling sites on your phone.
Yeah, so that's GamStop, and that has been a game changer for many gamblers, but it's reliant on the individual, the addict, to kind of isolate themselves, which, you know, is a pretty flawed approach anyway, because addicts generally don't make the best decisions. But secondly, GamStop is relatively easy to get around. There are hundreds of websites out there kind of giving tips on how people can get around that ban once they have self-excluded themselves. And in our story today, we feature, you know, a sort of case study of one guy who did get around it. You know, he was only doing it for sort of research purposes, but he shows how easy it is to get around. So the kind of the consumer protection, I guess, has been outsourced to the individual, to the gambling. That's the issue.
Gavin, thank you so much. Gavin Finch there, of course, with some great reporting, him and his team. And if you'd like to read Gavin's piece, just type NI Big Take on Bloomberg Terminal. You'll find it on Bloomberg.com. I also mention it in my social feed. Now, the UK's Financial Conduct Authority has undertaken research into online gaming and has highlighted harmful design practices to manipulate consumers in new ways and more easily than ever before. That's something that the regulator says encourages excessive risk-taking or risk appetite and gambling-like behavior. So we're now joined by Therese Chambers, Director of Consumer Investments at the FCA. So Therese, thank you so much for joining us on this very important topic. When you review certain platforms and look at gambling type obsessions, what have you learned and what's the next step? I don't know whether you can regulate them or what can happen to protect consumers.
Yeah, absolutely. So we identified a really significant increase in activity on trading apps that we decided to look into. And the research that we have recently published shows that there has effectively been the use of gamification techniques that are designed to draw investors in, to encourage them to increase the volume of their trading, and also to encourage them to increase the level of risk that they take as they're trading on the apps. And this is very concerning. It's very indicative of problem gambling type behavior. And we conducted in-depth research with over 3,000 consumers who have experience of using these apps. And many of them actually described their interaction with the apps as being like gambling. They described it as being similar to being a spread betting app.
So can you tell us a little bit more about some of the tricks you used? I guess some of the apps promoting gambling and risk appetite, and what you can do to respond or regulate that.
Yes, of course. So we see lots of positive reinforcement techniques. So when someone makes a trade, they get a big congratulations message. There's a shower of confetti on their phone screen. People get points and badges. There are leaderboards. So the more you trade, the higher up the leaderboard that you go. There are push notifications that give you really up-to-date news on market changes, price changes, to really build that fear of missing out emotion that can then drive investors potentially to respond by undertaking further investments. In terms of our next steps, well, we're following up with the trading firms. They are regulated by us, these 4 trading app firms. We're following up with them, and we are reminding them of their obligations under the new rules that we're introducing later this year, the Consumer Duty, which is all about protecting retail investors and all about requiring firms to act to deliver good outcomes for retail customers. And that's the discussion that we're having with those firms.
And have these firms engaged with you? Are they ready to change or make things a little bit easier, or do you see it as, we have to go harder on them once the rules come into place?
Yeah, we're in dialogue with the firms.
Okay. Therese, more broadly, how is the behavior of retail investors actually changing in this economic downturn? Are people taking more risk?
Yes, so I think it's a feature of economic downturns more generally that what we tend to see is that frauds and scams go up, and often when people are financially stressed, they look for opportunities to make money, and they can turn to high-risk investments. It's a big concern for us.
Therese, can you give us a little bit of a sense, when you look at crypto, and I know you don't regulate crypto, but how is consumer behavior changing? And again, can you strengthen the message because of what we saw with FTX? What are some of the things that you'll be working on in the next 12 months?
Yes, definitely. So interestingly, two of the trading app firms that we have looked at offer crypto, and what we have seen is a significant uptake in consumer purchasing of crypto assets through those platforms. Consumers should only buy crypto if they can afford to lose their money. That is the message that we have constantly put out to investors. And I think, what has happened with FTX is a really good example of the risks that are involved.
Therese Chambers, thank you so much for joining us, Director of Consumer Investments there at the FCA. Now, coming up, we're next for UK house prices. We'll also unpack the market with the latest data. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, UK house prices fell more sharply than expected in November. That's according to Nationwide Building Society. Now, the mortgage lender said home prices fell 1.4% over the month, the fastest drop since June 2020. Our Lizzie Burden has been taking a deep dive into the figures. So, Lizzie, good morning. Walk us through the latest data.
Well, Francine, all the data point in exactly the same direction, and that's to say that the UK is having a house price correction. The nationwide figures show that house prices fell the most in November since the start of the pandemic. But if you ignore COVID, it's the biggest drop in growth since the financial crisis. We've also had figures from the Bank of England which show that mortgage approvals are at their lowest since the start of the pandemic as well. And we've had data from Zoopla, the property portal, which show that the gap between asking prices and agreed prices is its widest since January 2021. So what's going on here? Well, we've had a mini boom in house prices driven by the race for space, people wanting bigger gardens when they're working from home, the stamp duty cut, and of course, pandemic savings. But now we're having the perfect storm in the UK because we've seen the rapid rise in mortgage rates, especially in the wake of Liz Truss's mini budget, a rise in taxes after Jeremy Hunt's fiscal statement, and both feeding into the cost of living crisis here in the UK. But where you've seen other asset classes rapidly readjusting to the global interest rate environment, house prices are only just starting to catch on.
So, Lizzie, what lies ahead? How much more are prices likely to drop?
Well, the Office for Budget Responsibility has forecast a 9% drop over the next 2 years, but there are a number of factors that could mitigate against that. So we've got a very well-capitalised banking sector in the UK. The poorest third of households actually only hold about 5% of mortgage debt. You've also got many more people on fixed-rate mortgages now than in 2008, and you can always hope that we don't get a big job shakeout during this recession. But I've been looking back, Francine, at history, and they've picked out the 4 biggest house price falls over the past century. And what you can see from the 1950s experiences, you don't necessarily need a big spike in unemployment as a prerequisite for a house price fall. But what we can also learn from history is that on average it takes about 8 years for house prices to correct themselves. So reality is they fall fast and they rise slowly.
All right, Lizzie, thank you so much. Lizzie Burden there with some great analysis and also a bit of a history lesson. Always go back in history to see what happened in previous crises. Now, for a broader look at the UK mortgage market within the European context, we're also joined by John Stepek. He writes for Bloomberg UK's daily investment newsletter, Money Distilled, former executive editor of the UK biggest investment magazine, weekly magazine, Money Week, also author of The Skeptical Investor, Guide to Contrarian Investing. I feel like I'm a skeptical house price commentator. First of all, John, when prices fall, so of course it's mortgage, but it's also just you don't know what the economy looks ahead or looks like in the next 12 months. You also see an opportunity maybe for foreign buyers to come in because pound is so weak. So what are you expecting in terms of mortgages and house prices?
I mean, honestly, in the UK, I think house prices are going to fall. I actually think Lizzie made a really interesting and good comment there, which was that most asset prices have already adjusted to higher interest rates. Yeah. Houses just don't do that as quickly. And the other thing that's interesting is the rate at which they do so is definitely linked to how fast interest rate changes flow through to the mortgage market. And in the UK, although the mortgage market, we do have more fixed rates, in terms of the kind of global context, our mortgage market is actually quite short term. Yeah. So, I mean, for example, a 10-year fix in Britain will have people looking at you as if you're, slightly mad. You're
mad because here we do 30 years.
Yeah, exactly. Right? Well, no, a 10-year fix here would be a very long time.
Yes.
Yeah. Whereas, for example, that's, that would be a short term in France.
We're all cursing, saying, I wish I had a 10-year fix.
Yeah, no,
right?
I do now. I don't want to talk about my own exploits in the housing market, but I have fixed for long periods of time when rates were falling in the past, and that, makes you feel like an idiot. Yeah. But the things that gives
I'm
you
brilliant
security.
at buying places, always at peak and sell at bottom. It's a great investment. I should read your newsletter more. John, overall, so how does it compare, first of all, with European, other European mortgage markets? And I remember the NatWest chairman coming on and saying, crunch time is actually mid-2023, where a lot of these fixed income mortgages fall off.
Yeah, I mean, that's the good point, because the 2-year fix, that one of the problems when we're talking about fixed rate mortgages, so a lot of people have taken out 2-year fixes. Yeah. So again, obviously they're quite short term. They kind of will be up the middle of next year. Now, it depends on what interest rates are doing at that point, but almost certainly, in fact, no, definitely anyone coming off a mortgage at that point is going to be paying more. Yeah. The question then is whether they can afford it. But in terms of actual house prices, the damage is already done, because regardless of whether employment stays high or not, the amount that people can borrow is going to drop. And that means that's the amount that people can pay for a house is going to fall. So, but I mean, I don't think there's any question that we're going to see house prices fall. No. The question is actually how bad does it get? And that depends much more on the actual economy.
So how bad does it get? I mean, we're not talking subprime levels, right? I don't know, because this, especially in the UK, we've already gone through a lot of that pain. So I guess mortgages, you can't borrow like 10 times earnings.
Yeah, exactly. And I think that's the other key point, is actually the UK is not as badly off as some European countries or some kind of global countries. I mean, if you look at Australia hadn't had a recession for about 25 years. It's now having one. Interest rates are going up. Because it hadn't had a recession for so long, house prices just kept on going up. And again, they've got a similar mortgage market to ours. So a small rise in interest rates has already seen, I think prices in Sydney are off about 10% year on year. And here in Europe, in Sweden, for example, and actually Denmark as well, Denmark had the world's first negative interest rate mortgage in 2019, which shows you, I know, it's nuts. I mean, I wish I could have got that. And so, interest rates were so low, and it doesn't take a very small rise for them to then have a massive impact on house prices.
John, you'll probably remember this, like 15 years ago, there was like a fashion of borrowing in Japan for like 0 interest rates. I mean, it's never good, because then you're very dependent also on currency swings.
Oh yeah,
right?
I mean, well, Poland's having that problem just now. The government had to step in and sort out, offer a lot of help to mortgage owners, because there's Lottie, a lot of people had borrowed in foreign currencies.
So invest in your currency is maybe wise, John.
Don't have your mortgage in a foreign currency. That's not a good idea.
John, thank you so much. John Stepek there from Money Distilled. Now, coming up, Bloomberg understands that the UK government will relax the ring fencing of banks as part of efforts to get a big bang out of Brexit. More on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, Bloomberg understands that the UK government will relax the ring fencing of banks as part of efforts to deregulate the City of London and get a big bang out of Brexit. This was first reported by the FT. Joining us now is Bloomberg's Tom Metcalf, who covers all things finance in the City of London. So, Tom, thank you so much for coming on. We've been talking about bonuses, about Collins, and now ring fencing. So first of all, does ring fencing even make sense in 2022? This was introduced on the back of the financial crisis.
Yeah, look, first of all, I should apologise for coming on your show and talking about ring fencing as the first topic. It's very one of these arcane things that have come out of actually the global financial crisis. I mean, I think this is a very specific sort of policy, and like you say, it's kind of been implemented already. So what the government is looking at is, can we roll it back a little bit, make it maybe easier for some banks? What they're finding is actually the banks who spent hundreds of millions on this, the Barclays, the HSBCs, they are pretty happy with it as it stands. They kind of almost now view it as sort of, they paid for it and it's kind of an advantage for them in terms of competition. So what they're really looking to do is kind of tinker around the edges, and it affects banks like a Virgin Money, a Santander UK, and a TSB. But
so what can we expect from this government? This is not the Truss government that wanted to, liberalise, deregulate, and kind of really boost the City of London almost at any cost.
Yeah. Well, and I was listening to your podcast yesterday, and it's, much more of a whimper what the banks are trying to do around Brexit. All this talk about huge Brexit dividends. What they're finding is, as they look at the regulations, it turns out the City of London is largely pretty happy with what they've got, and aren't looking for these kind of, this fire big regulations. So really what we're seeing under the Sunak administration is basically a little tinkering on the margins and just trying to get those advantages where they can. But often it's, business as usual.
So who are they trying to, I guess, sweet talk? Is it the Goldmans? Is it like JP Morgan? Or do they need to also try and find an agreement, for example, on clearinghouses to keep the EU on side?
Yeah, on the ring fencing, it sounds like it's largely targeting these sort of domestic UK lenders. Yeah. And in fact, they might be made sort of exempt from these requirements.
They could be the smaller ones, right?
Yeah, exactly. So it sounds like they're targeting people without big restricted trade, and i.e. anything with a big investment bank would not be affected by these changes. So it sounds like, JP Morgan, Goldman Sachs won't be impacted. We do talk to the Treasury and they say, look, this is still under debate. Nothing's been decided, so perhaps that changes. But right now, I'd say a Goldman and a JP Morgan, nothing changes for them.
And Tom, again, so I don't know whether they need to be more friendly to the City of London because of Brexit, so that because people had to leave, ring fencing wasn't really started because it wasn't an EU rule. So does it, again, give us an indication of the thinking of the government or of what else they could do?
Yeah, I think it's fair. They're sort of casting around for stuff to change and whatnot. And there's no obvious kind of, oh man, could we roll this back? Fantastic. Yeah. So instead, it's all these fairly arcane things, which I don't think really change the sort of debate or the structure of the city really in any great way.
Very quickly, the call-in. So this was basically, I love the call-in. This was giving ministers power to overrule regulators, but they scrapped that.
Yeah, no, exactly. So they backed away from that, which was a pretty explosive thing, draw a lot of attention in the city, worried the Bank of England, we understand. And they've kind of rolled that back and said, you know what, we will put that on pause. Yeah.
All right, Tom, thank you so much. Tom Metcalf there from our finance team. Now, for more on regulation, as Tom was saying, don't forget our UK and London Focus podcast, In the City. Episodes are out every Thursday on your favorite podcasting service. And this week, we're joined by City Editor Catherine Griffiths and the new Lord Mayor of London, Nicholas Lyons. So don't miss that. We discussed Big Bang, ring fencing, and bonuses. Well, that's it for Bloomberg UK. It continues, of course, in the next hour with Matt Miller, Kailey Leinz in New York, or Anna Edwards here in London, and this is Bloomberg.
It is likely that restoring price stability will require holding policy at a restrictive level for some time.
China risk is something to take seriously. The pressure is unrelenting, and it certainly hasn't gotten any better. If anything, it's gotten worse.
Look, I've had a bad month. There's going to be a time and a place for me to sort of think about myself and my own future, but I don't think this is it.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Stocks rally after Jerome Powell signals the Fed may slow down the pace of tightening as soon as this month. Still, Powell indicates more rate hikes are needed to fight inflation. Soaring mortgage rates take their toll in the UK. Home prices are now falling faster than expected. And disgraced FTX founder Sam Bankman-Fried makes his first public appearance since the crypto exchange collapsed. But he doesn't answer the question of where those missing billions have gone. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, Powell said something suitably dovish enough, it seems, for those who wanted to find it, who were seeking it, in his comments yesterday.
Yeah, whether or not it really was dovish, Anna, that is definitely how the equity markets and the bond market took it. And you saw follow through from that in the Asian session overnight. Remember, we are coming off the best month, the month of November, for Asian equities, going all the way back to 1998. We're talking 24 years, and then they started a new month, December, on a positive note as well. The MSCI Asia Pacific Index as a whole up about 1.7%, with Chinese stocks up about 1% as well. Now, part of that is related to China's specific news. The country's top official in charge of the fight against COVID-19 saying they are entering a new phase in combating the virus. So really just reinforces optimism about the reopening of that economy and the softening of curbs. But the other overarching story is that Federal Reserve and the dovish-ish commentary coming out of Powell, at least saying that they will be slowing the pace of hikes. So that is leading the dollar to be weaker against pretty much everything in Asia and G10 today. In Asia, it is actually the South Korean won that is leading those gains among those currencies. It's stronger against the dollar by about 1.4%, just shy of 1,300. That is the strongest won going all the way back to August. And then in the bond market, after the big rally we saw in treasuries, some follow through from that in Australia and New Zealand overnight. In New Zealand, the 2-year yield down about 7 basis points to 4.55, Matt.
All right, take a look at what's going on here to kick off the month. S&P futures are absolutely unchanged, which is puzzling considering we have such movement in a couple of other asset classes. The 10-year yield right now at 361, so a really relatively low level. It's coming up a little bit in yield, but it had fallen by so much. And the Bloomberg Dollar Index continues to fall further at 1264. So these two things should really be a tailwind for S&P futures, for stocks kicking off the month, although maybe traders are looking at November and saying, hey, it was a great month in November following another great month. So we've had a couple of big positive months. Maybe we need to give up some of those gains. In any case, Bitcoin climbing back up over $17,000. Really interesting after everything that we heard from Sam Bankman-Fried yesterday. Maybe investors didn't think there were too many takeaways that would indicate more shoes need to drop beyond the Genesis and Gemini pair that we're already watching right now. But I think it's very interesting to see the continued strength in this cryptocurrency. Anna, what do you see in Europe?
Yeah, here in Europe then, Matt, we're actually off our earlier highs. We were substantially higher than this earlier on in the session. The DAX still clinging to those, up by 0.4%. The FTSE and the CAC, though, dropping down to the flat line, really reflecting the slight weakening that we've seen in US futures coming through, as Matt was just referencing there. If we have a look at some of the detail behind this, and this being driven by catch-up, of course, with the United States, trying to play catch-up with Wall Street yesterday, where we saw the NASDAQ up by more than 4% by the close. But also, as Kailey was referencing, some of the at-the-margin reopening moves that we keep hearing about from China, all of that day by day having a bit of a positive influence on risk assets. This is the property sector for European equity markets, and we are seeing some of those risk-sensitive sectors doing particularly well. So property stocks up by 2.5% today. I've got a banking focus for you as well. Credit Suisse I put in just because it's such a heavy weight on the stock 600 and a weight downwards, down by 5.2% in today's session. And if it continues to lose ground today, that'll be 13 consecutive days in negative territory, which will be a record losing streak for the bank that has a number of issues. And we know all about those, of course. HSBC down by 0.9%. The CEO of the company has been talking. He's been confirming that, yes, he did consider breaking up the bank, but that wouldn't be the right path forward, the right course of action in his view. He's also responded to the potential for changing regulation around the banking sector in the UK, saying some of that would be welcomed. The euro against the dollar is up by 0.3%. Of course, this is very much the weakness in the dollar story, Matt, that you were just referencing, but the euro getting a boost from it and not being knocked off course by the fact we've seen some disappointing manufacturing PMI data, just underscoring the retrenchment that we've seen in the European economy, certainly the French data and the German data earlier on.
All right. Of course, we're going to keep our eye on French business as the French president comes to visit President Biden in Washington today. Let's get back, though, to the markets and the Fed. Chair Jerome Powell is signaling the central bank will back off of its aggressive pace of raising interest rates this month.
For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. We anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, it is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy. Despite some promising developments, we have a long way to go in restoring price stability.
Valerie Teitel, Bloomberg Markets reporter, joins us now to break down the post-Powell rally. So, Valerie, what made investors bullish after this commentary?
Look, he repeated a lot of the same things that he told us at the last press conference, but the one thing that he kept out was there was no major pushback of the loosening of financial conditions that we have seen in between last night and the November FOMC meeting. And take no doubt, I mean, the loosening of FCON since that meeting has been significant. Bond yields have fallen, the dollar has weakened significantly, and equity markets have rallied, but yet Powell didn't talk this back. And that's one major difference. The Powell during the summertime, during July and August, he was very keen to always talk back any loosening of financial conditions, and he notably did not do that yesterday, and that is why the equity market took that in stride. Now, it's not just the equity market that's pushing trend lines, but it's also the dollar. They're both concurrently testing their 200-day moving average. It just goes to show that this has been a huge reversal in November of these key macro themes from this year. Stocks have really bounced the last 2 months. The dollar has fallen significantly, one of the steepest monthly drops we've seen in 12 years. And look, now that we know that the Fed is likely to go 50 in December, regardless of how this Friday's payroll print goes, regardless of how the CPI print the day before the FOMC decision goes, that's taken a lot of uncertainty out of the rate path. And I think that these moves could probably extend into year end, given that uncertainty is now off the table.
Okay, Valerie, yeah, maybe it was all about FCON. Maybe that was enough for the stock bulls. Valerie Teitel with the latest on what Powell said and how the markets received his message. Let's get back to the European economy and specifically the UK. The housing market here has had a tumultuous few weeks. Lizzie Burden has been taking a deep dive into the figures. Lizzie, walk us through some of the latest data, some of it coming, of course, this morning.
Yes, Anna, all the data point in the same direction, and that's that the UK is headed for a house price correction. We heard from Nationwide this morning. It said that house prices have fallen the most in November since the start of the pandemic. And if you ignore COVID, it's the biggest drop in growth since the financial crisis. We've also had data recently from the Bank of England this week. In fact, mortgage approvals have fallen to their lowest since the start of the pandemic. And Zoopla, the property portal, says that the gap between agreed and asking prices is its widest since January 2021. So what's happening here? We've got the perfect storm because we've got rapidly rising mortgage rates, especially after Liz Truss's mini budget. We've got higher taxes, especially after Jeremy Hunt's fiscal statement, both of them feeding into the cost of living crisis. And where you've seen other asset classes, equities, bonds, rapidly adjusting to the new interest rate environment globally, in the UK, house prices are only just starting to cotton on.
So what lies ahead then in terms of the continued drop, or does this look like the end of it?
Not quite, Matt. The Office for Budget Responsibility is forecasting a 9% drop over the next 2 years. There are some mitigating factors. We've got a very well capitalised banking sector in the UK. The bottom third of households only hold about 5% of mortgage debt. We might not see as big a job shakeout as we have in other recessions. But history tells us that when house prices fall, they fall fast and rise slowly.
All right, Bloomberg's Lizzie Burden, thank you so much. Let's turn now to the world of crypto. The missing billions from the collapse of FTX are still a mystery. The disgraced founder of the crypto exchange, Sam Bankman-Fried, told the New York Times Dealbook Summit yesterday that he made a lot of mistakes. It was his first major public appearance since FTX imploded.
Whatever happened, wherever it happened, I had a duty to all of our stakeholders, to our customers, our creditors. I had a duty to our employees, to our investors, and to the regulators of the world to do right by them, to make sure the right things happened at the company. And clearly, I didn't do a good job of that. I was shocked by what happened this month.
He said it's been a bad month for him. Joining us now is Ana Herrera, Bloomberg senior crypto editor. Ana, what did we learn from that interview? Was there really anything new?
No, I think we were left with more questions, really, like namely what happened to the $8 billion that are missing and what happened, why is there a hole? I think he sort of alluded to the fact that Alameda, his trading firm, had a big margin position on FTX, but he was unaware of the size of the margin, which then I guess begs the question why, if you were, the exchange giving the margin. But yeah, we don't really know. He did say, I guess he didn't willingly commit fraud. He wasn't trying to commit fraud, but it still leaves so many questions unanswered, like what actually happened.
Yeah, it seems like, I watched this whole interview while I was preparing dinner last night. It seemed to me like he said Alameda made huge bets with FTX money, leaving collateral at FTX. Then Alameda lost those bets and the collateral became worthless. So it seems to me pretty clear that those billions are gone.
Yeah, the question is, like, how much should he have known? If the two firms are his, essentially, right? And I guess he was saying he was worried about, conflict of interest, and that's why he wasn't involved with Alameda. But, there's been different reporting over the past few weeks that show, maybe there was more connection and commingling of funds. That was a big part of the interview. He was asked, was there knowingly commingling of funds? And he sort of said no, but then there were discussions about how Alameda's accounts were being used to transfer money into FTX in early days, which again raises even more questions. It sort of like answered questions, but really left us wondering, so like, what's actually going on? What should he have known? What did he know?
Right, the questions are less about where's the money and more about who holds the culpability, right?
Yeah, and I guess more will emerge during the bankruptcy proceedings for sure. And then we know there are investigations in the U.S., so I guess some of that will emerge, right? And he's still been talking. We haven't been hearing Alameda's former CEO, Caroline, speak, so.
Yeah, Caroline Ellison, another important figure in this. We will continue looking for answers to these questions. Ana Herrera, thank you so much. And we'll continue to cover SBF and the FTX fallout on Bloomberg Crypto. You can catch that every Tuesday at 1 p.m. New York time, 6 p.m. in London. Now, though, let's take a look at some stocks moving in pre-market trading on this Thursday here in the U.S. A number of them related to earnings, including Salesforce, which reported after the bell yesterday. Disappointing outlook. Analysts saying that's really reflective of the softening macro environment. Plus, the co-CEO, Brett Taylor, is leaving the company, leaving just Mark Benioff at the helm. So that's a bit of a surprise. As a result, the stock down about 6.4%. It is also a drop after earnings for Snowflake. This is, of course, software company. It helps businesses organize data in the cloud, and the fact that their revenue forecast disappointed indicates that companies are slowing down their tech spending, their customers, that is. And as a result, Snowflake is down about 4.8%. I also wanted to check on some of those Chinese technology companies with listings here in the U.S. because those ADRs were roaring higher in the month of November. Alibaba had its best month since 2015. JD.com had its best month on record with a 50% rally last month, but they're starting a new month giving some of those gains back. Alibaba down about 2.5%, JD by about 2.75%, and Bilibili also down by more than 3% before the bell, Anna.
Okay, we'll keep an eye on those movers. Kailey, coming up on the programme, we'll talk to Carsten Brzeski, ING's chief economist. What does he make of the comments that we got from Jerome Powell yesterday? And what does he make of the underlying weaknesses and points of weakness in the US economy? We had some interesting data on that front yesterday too. We'll get to Carsten on that. We'll also talk to Peter Trubowitz, Professor of International Relations at the London School of Economics. Matt was saying we'll keep an eye on French movements, and that's because the French President Emmanuel Macron is in Washington. There's a lot to discuss between Europe, the US and China. This is Bloomberg.
Welcome back to Bloomberg Surveillance. I'm Matt Miller here in New York with Kailey Leinz, Anna Edwards with us out of London. Now, we have seen the end of another positive month. The S&P 500 is up more than 5% after a big rally of more than 7% in the month previous. Do we have a chart? Did we look at the chart already?
We saw the chart.
We saw the chart?
was there.
Yeah,
if
it
you're
was
listening on
pretty great.
radio, you can find it on GTV Go on your Bloomberg terminal.
Thank you very much. Joining us now is Nora Melinda, Bloomberg equities reporter, to talk to us about what happened, why the big gains when it felt like it was a down month if you weren't looking at, HCP space M.
Yes, that's a really good point, and good morning. Thank you for having me. The S&P is actually on track to snap its longest quarterly losing streak since the global financial crisis in 2009. And of course, a lot of people are just looking at Powell's comments and analyzing that yesterday. I think that it's really interesting to note that despite the fact that we had more down days last month in November than we did have up days, the S&P still posted 2 consecutive months of gains the past 2 months, which I think is really noteworthy despite the fact that a lot of people have been having some negative sentiments, especially with everything going on with inflation.
So you say there actually were more down days than up, which means that the up days were just large enough to make the difference. Those are really big moves within this equity market. So a lot of volatility, it would seem. What is the VIX actually reflecting?
Yes, so the VIX is really interesting because, of course, we had earlier in October, we had a lot of volatility. We were seeing the VIX above 30, like the 30 handle. But now, as we're looking at the VIX, we're actually watching to see whether or not it will break below 20.
All right, so that's the story on the VIX. Good morning to you, Nora. Thinking about where markets go from here then, given what you've just painted, the picture of sort of low volatility and stocks have been doing well for the last couple of months or so, what are your sources saying will happen in December? It seems that traders will have some data and a Fed meeting to focus on. They can't just watch the soccer or the football.
Exactly. And as you mentioned, we actually do have data coming out later today. We'll be looking at PCE, which is the Fed's preferred gauge of inflation. And that doesn't quite actually include a close look at housing. So I think that typically the market will move on CPI more so than PCE. But given Powell's comments yesterday, I think that that's something that we'll actually be analyzing today. As we're looking forward into the month of December and closing out the year, if the S&P were to maintain its current momentum, it has the potential to post its first, it has the potential to post a really great month and end these past 3 months in a great quarter.
Yeah, potential for a Santa rally there. Nora, thank you very much. Bloomberg's Nora Melinda joining us with the latest on the markets. And for more market analysis, check out MLIV Go on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. 3 years since the world's first documented coronavirus patient in China, and the country is finally pivoting away from efforts to quash the pandemic. China's COVID czar says the fight has entered a new phase, and the government is making some concessions, such as allowing some low-risk patients to isolate at home instead of in controversial quarantine camps. Key European Union members are looking at a compromise on a Russian oil price cap. Bloomberg's learned they've discussed a $60 a barrel limit to help reach a deal with the EU's wider membership in the broader Group of Seven. The goal is to keep Russian oil flowing to avoid a global price spike while limiting Moscow's revenue. A standoff between Twitter and Apple appears to be easing. Elon Musk met with CEO Tim Cook at Apple's headquarters. Afterwards, Musk said Cook told him Apple had never considered removing Twitter from its App Store. Musk began criticizing Apple after the iPhone maker reduced its advertising spending on the social network. And when France's President Emmanuel Macron dines at the White House tonight, the menu will include lobster, caviar, and an Oregon cheese named the best in the world. It's President Biden's first state dinner since taking office. Yesterday, Macron visited NASA and met with U.S. veterans. And the name of that Oregon cheese, Matt, is one I honestly have never heard of, even though I've been to Oregon and am an American, and it was the only U.S. cheese to ever win the World Cheese Award, Oregon's Rogue River Blue.
I also have never heard of that, and I don't know how you can judge the best cheese in the world. Are there definitive metrics? Anna, you're the cheese fan, so what makes one cheese that much better than the other?
Well, I'm sure you should ask the fine food whatever organisation that announces this award. I do think it's a brave move by the White House to present the French president with a cheese deemed to be the best in the world. I imagine he might have a few views of his own to share. I was amazed by the menu. Maine lobster, American caviar, ravioli, steak and potatoes. I mean, this sounds like about 5 meals, not just one, but I'm sure they'll all enjoy it.
And there's
coming
up
on the programme,
we will.
Yeah, absolutely. They have a lot of policy conversation to fuel. We'll actually pick up on some of that because there's a concern across the Atlantic around trade and protectionism. How much does that weigh on the mind of Carsten Brzeski? He joins us next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Stocks rally after Jerome Powell signals the Fed may slow down the pace of tightening as soon as this month. Still, Powell indicates more rate hikes are needed to fight inflation. Soaring mortgage rates take their toll in the UK. Home prices are now falling faster than expected. And disgraced FTX founder Sam Bankman-Fried makes his first public appearance since the crypto exchange collapsed. But he doesn't answer the question of where those missing billions have gone. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European equity markets were trying to rally following what happened on Wall Street post-Powell, but the effect of that seems to be fading a little bit as we get towards the start of US trade.
Yeah, it doesn't seem to be phasing at all. Maybe traders just put a complete reset button after November and to kick off December because we're doing nothing on futures. Now, it should be said, we had a pretty great November. I think we were up 5.4% on the S&P in November. We were up 7% and change on the S&P in October. So 2 consecutive months of big gains, and maybe that's why you don't see a lot going on in futures today. But we have very low 10-year yield compared to the high that we saw a month ago, right? We were at 420. A little bit more than that, and right now we're at 361.63. It's coming up a little bit, but not enough to really write home about. And we have a very low Bloomberg dollar index, right? We were at 1350, now we're at 1264. And so those things, that pressure coming off should allow equities to rally further, although maybe that's what we saw already priced in the last couple of months. I also think it's fascinating to see Bitcoin now climbing back up over 17,000. And for those of you who watched yesterday the Sam Bankman-Fried interview with Andrew Ross Sorkin, I thought it was pretty clear that he said the money is gone, right? I mean, Alameda made some huge bets with collateral that then became worthless, and Alameda lost those bets. So those billions are out of there. The question is who's responsible for it and why, in that case, do we see Bitcoin continuing to rise as we worry about now the next shoes to drop, be it Genesis or Gemini, as we try and figure out what happens there, Kailey?
Yeah, I mean, didn't Larry Fink at that same conference say he expects that most crypto firms are ultimately going to collapse in the wake of it? So definitely interesting to see such stability for the biggest cryptocurrency out there. Now, we also, as you mentioned, are seeing relative stability in the future session because a lot of those heavy hitters that led the gains yesterday, the big tech stocks, aren't really coming to play ball on this Thursday morning, the first day, as you said, Matt, of December. The likes of Tesla and Apple down in pre-market trading by 0.8% for Tesla, 0.4% for Apple. Much bigger moves, though, for two companies that reported earnings after the bell yesterday and gave disappointing revenue outlooks. Salesforce, one of them, softer macro environment, likely to blame for that. Plus, the company's co-CEO, Brett Taylor, is leaving, so just Mark Benioff is going to be leading the charge. That stock is down 6.5%. And then Snowflake, the software company, organizes data in the cloud for businesses. Also disappointed, signals that there's just not as much technology spending going on the customer side right now. So Snowflake down about 5.25%, Anna.
Yeah, that's an interesting one, given the sector is already shedding jobs, as we know. Kailey, this is what we see in Europe then. Actually managing to eke out gains here in Europe, more than that perhaps, up by 0.7%. But it's certain sectors that are doing well today. It's not the likes of energy. That was the story of days ago. But the property sector doing pretty well today. So rate-sensitive sectors on the rise, up by 2.4%. HSBC I put in because we heard from the CEO a little bit earlier on, and he was speaking at a conference saying that, yes, he had considered breaking up the giant business that is HSBC, but decided it's not in the interests of the business. This was something that one particular shareholder had been pushing very vocally for. He also welcomed the talk about some changes to regulations here in the UK and weighed in on Chinese-US geopolitics, saying that the recent meeting was promising. This is the euro, 104.38. To Matt's point, though, we see a lot of dollar weakness, not necessarily really euro strength today, but the euro is up by 0.3%, despite the fact we had some disappointing data when it comes to manufacturing PMI from certain countries in the eurozone, certainly some of the larger countries, and really underscoring that the headwinds that Eurozone economies are facing. And certainly the PMI data suggesting we're in contraction already.
Do you know, I think sometimes we come on this early in the morning, at least for us, Anna, and we talk about futures, but we don't always shed a lot of light on what happened yesterday. And we should on a day like today, when yesterday's rally was so strong in the U.S., in U.S. stocks, right? We saw a more than 3% gain on the S&P 500. We saw the Dow Jones Industrial Average adding 737 points after Jerome Powell gave his speech at the Brookings Institution in Washington, D.C., and kind of confirmed the step down for us. Let's talk about why that may have been the catalyst for such a big rally. Joining us to discuss is Carsten Brzeski, ING DIBA Chief Economist. Carsten, you know, why did those comments from Powell, essentially saying we're still going to see 50 basis point rate hike at the next meeting, which in a normal world is a lot, why does that drive a 3% rally on the S&P?
Well, this is not a normal world, Matt. We know that. Just remember a couple of weeks ago when U.S. inflation was 7.7% and the market was also cheering, while the market probably six months ago would have been really extremely painful. So this is just that the end of Fed rate hikes is coming nearer. The sheer fact that the Fed will really slow down the pace of rate hikes is such a support factor for equity markets right now, because markets they feel confirmed in the speculation that the near of rate hikes is coming closer, or the end is coming closer.
I wanted to ask you about the underlying picture, Carsten, for the US economy and how quickly we get to a recessionary picture, if that's where you think we're going in the US. I saw yesterday, I mean, the Chicago PMI data yesterday, taking some people by surprise, looking really weak, coming in below 40. And one of our colleagues on the Markets Live blog saying it only does that when we're either in recession or we're just coming out of a recession. So it certainly doesn't tell a positive story. What are you seeing in the sort of high frequency data that you look at for the US?
No, we're clearly seeing this slowing down of the U.S. economy, and we still have a recession penciled in for the first half of next year. We do see that, for example, pricing power by corporates is coming down. We see that demand is coming down by consumers because of high inflation. And we'll also see that the real estate market is clearly slowing down, with mortgage rates north of 7%.
Right, okay, and that's what you're watching in the United States. And clearly the US government wants to do things to support the economy, just like many other governments do around the world. One of the things they've been doing is the Inflation Act, and this has annoyed some people in Europe, certainly some politicians, some companies that manufacture. I wonder how substantial you think this argument around trade is going to be, because we have Emmanuel Macron, the French President in the United States. Are we talking about a period of concern about protectionism, or would that be too strong?
No, it's not too strong. I think this is pretty much what it's going to be about. We know since the 24th of February, when the war in Ukraine started, that the U.S. will somehow economically benefit because the U.S. is a net exporter of energy. Europe is a net importer of energy. So this was already kind of shifting the balance between the U.S. and Europe. And now with this Inflation Reduction Act in the U.S., so there will be more kind of support for the U.S. economy while Europe is facing this recession coming up. So clearly this is a protectionist story. And yes, Europe is, as so often, waking up quite late. Macron now being in the White House.
And it's protectionist because of the support being provided for sort of Buy American? Is that what the argument is about?
It's for buying American. It's for producing in the U.S. So this is clearly supporting the production factor or the production location U.S.
Can I just jump in here and point out that a lot of this is about cars, right? I was talking to Anna and Kailey about this before the show. Emmanuel Macron is French. We should remember, he's the president of France, right? We don't buy any Renaults, Citroëns, or Peugeots here. The only French car you can buy in America is a Bugatti. So it's the Germans, Carsten, that should have a real issue with this Inflation Reduction Act.
Yeah, correct. But maybe it is that Macron is kind of the messenger for Olaf Scholz, because you're fully right that it is the German automotives that will suffer more and most from this Inflation Reduction Act. But yeah, we know this. Europe very often likes to speak with several voices, and I think it's now Macron trying to have the first discussion with Joe Biden on how we can really avoid a trade war or kind of more protectionism. I wouldn't call this a war, but more protectionism between the US and Europe, just in a time in which actually these two regions need each other.
Okay, so Carsten, that's trade between the U.S. and Europe. There is also the very large China question, which seems to have been at the forefront, at least over the month of November. What are you actually modeling in terms of the growth and the demand the Chinese economy realistically is going to contribute to the global economy in 2023?
Well, that is a very tricky one, Kailey. It's what we're seeing here is actually we have two ways forward. So either the Chinese government is really lifting the COVID restrictions, so getting away from zero COVID, which then should be beneficial to the global economy, while on the other hand, it would probably also push up energy prices and then would hit Europe via the energy price channel. On the other hand, if zero COVID remains in place, and I think we will see more lockdowns, we will see more supply chain frictions, and that will clearly be negative for the global economy. I think in total, you could argue that China will clearly not be this big push factor for the global economy. It has been a couple of years ago.
Okay, but it could be potentially an upside driver of inflation, Carsten, through the energy and commodity mechanism. So as we kind of think about inflation and the realistic trajectory of it going down next year, it's one thing to talk about the Fed that is going to slow down the pace of rate hikes and then ultimately end up at terminal. It's a completely separate conversation to talk about when they realistically could start cutting. Do you see any real probability that that time could come next year?
Yeah, it's not consensus, but we do see that there could be a moment after the summer at which the Fed will start cutting interest rates again. Why is that? Because we expect inflation in the U.S. to come down much faster than people currently expect. 1/3 of the inflation basket or index in the U.S. is driven by real estate, by rents, by shelter. And with these high interest rates, I think it is normal to expect that this portion of the inflation index will come down significantly and then push down headline inflation, which should allow the Fed to start cutting rates again after the summer next year.
Yes. Carsten, thank you very much for your time. Carsten Brzeski of ING Germany. I think I know who that was. Right, coming up on the programme, we'll talk geopolitics, transatlantic geopolitics. We'll also talk about China, how that gets into the mix in those transatlantic relationships. We'll talk to Peter Trubowitz, LSE Professor of International Relations. He joins us shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today on Bloomberg Television, we will have an interview with Mary Barra, the CEO of GM. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, obviously, today we are having our eyes on the White House, where a fancy state dinner with all sorts of fancy foods is going to be taking place between President Biden and French President Emmanuel Macron, who is in Washington. It is the first state dinner that President Biden will hold under his administration, but it does come at a time where there are contention points between the U.S. and its oldest ally. Joining us now to discuss is Peter Trubowitz, Professor of International Relations at the London School of Economics. So, Professor Trubowitz, thank you so much for being here. Obviously, the U.S. and France have long been friends and allies, but there are points, whether it be China, whether it be the Inflation Reduction Act and some of the benefits toward American EVs that we were just discussing in our prior block, there are issues. How would you characterize the health of the relationship between the U.S. and France as these two meet?
Good to be with you, Kailey. I think, as you pointed out, this is America's oldest ally. There's a lot of history. Many ups, some downs as well over time. Certainly, the decision that was taken, the AUKUS decision a year ago, caused trouble in the French-American relationship. But I think it's a pretty strong relationship right now, and both sides are working hard. They have incentives to work hard to keep the bonds strong. You know, I think there's two things about this visit that are notable. First, the nod that goes to a European. I mean, given all the talk to a European ally, given the administration's very heavy focus on China in East Asia, it's notable that it goes first to Europe. And when it comes to Europe, I think the thing that people need to keep in mind here is that Biden needs a really reliable interlocutor on the European side to negotiate out differences on Ukraine, on China, and other matters. And right now, given the uncertainty about political leadership in Britain, in Germany, and Italy, I mean, it's really not a surprise that Macron is the one they're going to. In fact, I think the hope in Washington is that Macron, who cannot run for re-election again in France, will have more flexibility politically than these other European leaders to work with the United States.
Why? Well, I mean, first of all, in Italy, there is never anything but uncertainty in terms of their leadership. But in Germany, you know, there's hardly a vast chasm between the SPD and the CDU. I would say they're pretty stalwart. Why not have the Germans be, as they historically have been, our best friend in Europe?
Well, that's the question. How come they didn't go to Schultz first? And I think the reason is because they don't think that Schultz is showing the leadership that Macron is. Macron is on top of, is out front on a lot of issues. Americans disagree with some of the things that he does and some of the positions that he takes, but there's a clear, there's energy that is coming from Paris. And I think they see him as probably the best bet in trying to reconcile differences, whether they be over Ukraine. There's some distance, and we can talk about that between the two sides. Clearly over China, and the Germans have been a problem for the United States on that. And on the trade issue, in some respects, Macron is probably their best bet in trying to negotiate out something.
Right. Good morning to you, Professor. So is there some sort of deal to be done on these two subjects of Ukraine and trade? The United States wants more support from Europe in fighting, in money for fighting, I should say, in Ukraine. The Europeans want some softening of the Inflation Reduction Act in the United States. Is there any kind of trade to do on those?
Well, I think maybe, but I think probably what the Europeans want most proximately from the United States is some reduction in the cost of liquid natural gas exports, which the prices have surged in Europe due to the cancellation of Russian deliveries, Putin's sabotage, of the gas lines and so on. And so I think if there's a deal that is struck, it will probably be between, a larger military commitment from Europe. And again, the Germans have been a problem here, but the French less so, in return for some relief on gas. I think the question that you're raising on Biden's tax incentives, that, the incentives that come with the Inflation Reduction Act, that's a huge issue right now, getting a lot of oxygen. I wouldn't look for an agreement, a deliverable on that. I'll be surprised. Maybe it happens. I think what's more, through the meetings today and in tomorrow in Washington, I think what's probably more likely is that they're able to set the table in a way for negotiations that will actually begin as soon, lower level negotiations next week, to see whether or not there's some play in how the subsidies are defined. Right now, they're defined broadly for North American, firms that they deal with both the United States, but they cover also Canada and Mexico, and whether the Treasury Department can expand that. But the question, it seems to me, is what does the United States get in return? If it does cut some slack, and there, I might look for a little pressure being applied to Macron over Europe's stance on China. The United States wants Europe to close ranks.
Yeah, and we just heard from the EU's Charles Michel, who's actually in China right now, reiterating the EU's commitment to the one China policy, perhaps a little less ambiguous than the United States position. I wonder if that will be brought up. Peter, thank you so much for joining us. Peter Trubowitz joining us from the London School of Economics. Coming up today on Balance of Power, Senator Rick Scott joins the team, Republican from Florida. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, let's have a look at what is ahead today. We'll get some U.S. economic data. That'll include U.S. initial jobless claims and the PCE deflator report, favoured by the Fed, of course. At 10 a.m. Eastern, CFTC Chairman Rostin Bayman testifies on lessons learned from the FTX collapse. Maybe we'll learn more today than yesterday. More Fed speak today, including a speech from the Fed Vice Chair for Supervision, Michael Barr. Will there be any pushback on market response to yesterday? And French President Emmanuel Macron, we talked about this already, heads to the White House. We'll have a joint press conference with President Biden at 11:45 Eastern and a state dinner at 7 p.m. serving, well, all kinds of things. Seems like every food group you can imagine, including a cheese from Oregon that once won the award for the world's best cheese. Matt?
Probably not a French award, right? I'm assuming we keep saying that it was awarded best cheese in the world, and I'm guessing that was an American judge. All right, let's talk about, well, a guy who used to run a French auto manufacturing company, now back at his previous post as the head of Lamborghini, Stefan Winkelmann. Lamborghini just unveiled the latest version of its $270,000 Huracan supercar, the Sterrato version of that car. Takes drivers off the highway just slightly onto some dirt or gravel road. I spoke with Winkelmann about what else is in the pipeline at Lamborghini.
We are the super sports car factory with the Huracan, and the Aventador follower is now changing a lot. We are building a new assembly line, which when the new Huracan as a hybrid is coming at the end of 2024, will not be two as it's today, but there will be then one line which is being able to produce both of the super sports cars. By the beginning of next year, actually, we will have a last incredible surprise on the V12 engine only. There will be a very nice announcement, which I will not anticipate too much, but in January we will do a big announcement about a single car, which is going to be phenomenal, and this is then still based on our actual V12 engine.
All right, so very cool to hear more about the trend to Safari, a sports car. It has been done with the 911 for years. They made it official last month with the Dakar version. Now Lamborghini's doing it. I hope Ford and Mustang are the next to do it. But also interesting to hear that Lamborghini is going to completely shift the production line, Anna, to produce EVs. So they want to squeeze out as many special editions of their gas cars as they can before they do that.
It still looks too fancy for a campsite, is all I can say, but I'm sure somebody will take it there, Kailey.
Yeah, well, and Matt brought up potholes in the interview, and that's something to consider as well. You don't have to go out to the desert. That wraps it up for Early Edition. More surveillance is ahead with Tom, John, and Lisa. This is Bloomberg.